Good morning, everyone, and welcome to this webinar that is co-presented by Gilmore Jason Mahler, Public Accounting, and also the Findlay-Hancock County Chamber of Commerce. Our topic today is PPP loan forgiveness and the fact that it just got easier, which I'm sure is welcome news to many businesses. We're going to be hearing from Gilmore Jason Mahler's Bob Bobek in just a bit. Couple quick housekeeping items for you. Wanted to let you know we're going to get to a Q&A section at the end of the webinar, so please, throughout the course of the webinar, if something comes up or pops in your mind, you got a question for Bob, please let us know and we'll tackle those questions at the end. And also there is a handout. If you're interested in downloading the slides, you can do that as well. From there, I think I'm just going to toss it over to Doug Jenkins with the Findlay-Hancock County Chamber. And Doug, thanks so much for working with us, and we're thrilled to be partnering with the Chamber for this webinar.
Well, thanks, Susan. Good to be here this morning, especially knowing that it's a short week. That's not too bad. Yeah, as far as the Chamber's role in this, one of the things that we've always tried to do is give our members as much information about how they can, effectively run their business as they can. Certainly, with the onset of COVID-19, a lot of our focus changed to how do you keep the doors open and move to an online format. And so we've been doing a lot of webinars like this. So it's great to have partners like GJM who are willing to put these together for not only our members, but the greater community as a whole, and ultimately get that information out there to our business community that'll help them. That's what we're about doing. And certainly if you have any questions about some of the other things we've been doing, I'd be happy to answer those after this is over. But I think with that, I'll turn it over to Bob Bobek and we'll get started.
Thank you. So we're here to talk about the PPP loan program, the process to go ahead and ask for forgiveness once you meet the requirements of that program, and then some other ideas to help businesses with cash flow in these troubling times. This all started with when Congress voted and the president signed the CARES Act. That was on March 27th. It was a Friday. Seems like everything in this program is happening on Fridays. And they allocated $348 billion for a new program called the Paycheck Protection Program. And this program is basically allowing the federal government to provide liquidity into the U.S. economy. And this time around, they're going through businesses, small businesses with less than 500 employees. I mean, the last time we had a significant downturn in the economy in 2008, they had the TARPS program that put an equivalent amount of money into the economy. But in that period, when they did that TARPS program, they did it through the banks. And it was very slow in getting out the money into the economy. And most banks, by the time they had the ability to access the money, declined to access the money. So under this CARES Act, they wanted the money very quickly out into the economy. And so as part of this, the PPP loan program, as long as you spent the money on certain areas, such we're going to talk about today, like payroll and related cost, interest on loans, rent, and utilities, within a specified time, 8 or 24 weeks, that amount would be forgiven because you've done your duty in getting the money back out into the economy. And the whole idea behind this was to slow down the rising unemployment. So when this money first became available, everyone acted upon it quickly, and the money dried up by April 16th. The $348 billion was allocated. So then on April 24th, about a week later, Congress passed a second round of funding of $310 billion for the PPP loan program. And they put another $50 billion into the economic injury disaster loan because that was also used up by approximately April 16th too. So they refunded that program, which we're going to talk about later today also. And then the third act that just came into being on June 5th, and it passed the House by 417 to 1 and unanimously by the Senate, was the Paycheck Protection Flexibility Act. It's really a simple act. It's about 2 pages long, and it just made a couple of things a lot easier. The biggest being it changed the period to expend the money from 8 weeks up to 24 weeks. And then it also made some other abilities to get forgiveness more laxed. So it was really there to help to make sure that this money was received by small businesses and ultimately forgiven. So what is the Paycheck Protection Program? It is a SBA 7A loan program. And so the SBA administers various loans for the federal government, like economic disaster loans. They already have a relationship with all the major banks in the country, so it was a good way to push the money out from the federal government into the businesses, and ultimately into the economy. The way it works, you fill out an application based upon 2.5% of your payroll, monthly payroll, and that's the amount of the loan. Once you received approval, the banks had 10 days to process and make sure you had your money. Again, round 1 was fully allocated April 16th. Round 2 is still available. It officially closes out tomorrow, June 30th. But as of June 27th, again, I think that was over the weekend, there's approximately $134 billion still available for allocation. And this has actually gone up from a week ago. So I don't know if they freed up more money or some loans have been paid back, but it used to be $128 billion available. Now it's $134 billion available. So here's the most recent report from the SBA. Again, it's showing that there's been a total of almost 4.8 million loans for $519 billion. Some things about the lender segments. This one is then listing the loans by states. Ohio is coming in at 7th. We're in the middle column towards the bottom. About $18.3 billion in loans have been granted to companies in Ohio. The loan size, as you can see, the magic number that we're going to talk about later is 2 million, less than 2 million. And there's only about 0.6% of the loans over 2 million. So all the rest of the loans are under 2 million. And so that's almost 99% of the loans. And the average loan size is 108,000. So there's a lot of smaller loans in this pool of loans. And then this is a listing of the banks. As you can see, all the major banks were the leading lenders under this program. And ultimately, this is the final slide here that shows it broken down by industries. Healthcare is leading the amount of loans, followed by professional, scientific, and technology services. Construction is next, third, and manufacturing is fourth. So those are the top 4 industries using the program. And here's the final page. It shows there's $134 billion available as of June 27th. So real quick, as we spoke about earlier, you're already probably familiar with this. The maximum loan is $10 million. It's based upon 2.5 times your monthly payroll of 19 monthly payrolls. The loans have a maximum maturity of 2 years at 1% interest. It is 5 years for loans that originate after June 5th. So those loans that originated after the most recent act, the PPP Flexibility Act, you can now have up to 5 years to repay any amount of the loan that's not forgiven. Also, as I go through this presentation, the items in bold green are the latest updates related to the PPP Flexibility Act. Again, allowable uses, payroll costs, group health insurance, interest on mortgage payments, rent, utilities, and interest on other debt obligations, and also any retirement benefits. You're not required to segregate the PPP loans in a separate bank account. A lot of the bigger banks simply did not want to take the time to open up new bank accounts. So a lot of the money just went into your general checking account. We're going to talk about the process that's available to get loan forgiveness. And we're also going to talk shortly about the certification, the current economic uncertainty certification. In the last act, the PPP Flexibility Act, no new loans can be approved after June 30th. So tomorrow is the final day to access that $134 billion that hasn't been accessed yet. There'll probably be a lot of money gone unused. So what is this uncertainty certification? Okay, so a condition of your application to get a loan is you had to make a good faith certification. There was uncertainty within your company due to the pandemic, creating a necessity of the loan. So the actual certification is right there. Current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. The SBA, under guidance, ruled that loans under $2 million will automatically be deemed to meet this definition. Loans greater than $2 million will be subject to review by the SBA. I know when this first came out, it all came out when it was determined early on that publicly traded companies, some of these large national chains of restaurants with 40,000 employees, access the program, because in 2 industries, you were allowed to have less than 500 employees per location. That would be the hotel or accommodation industry and the restaurant industry. So there's large chains of restaurants that access this loan. And so the president said, no, that was not the intention. So with a Q&A, the SBA ruled, or came out with some guidance, that a borrower should consider your current business activity and ability to access other sources of liquidity. It is unlikely that a publicly traded company with substantial market value or access to capital markets will be able to make this required certification. So again, it was very clear here that they were saying that publicly traded companies probably did not meet the definition of uncertainty because they have access to other sources of capital. So let's say the SBA determines that you do not meet this definition and you're over $2 million. The end result would be it'd be converted to a loan. You would not be eligible for any forgiveness, and you would have, depends on the timing of the loan, either 2 years or 5 years to repay it at 1% interest. It's also very clear in the program, in the law, that the government has waived the normal SBA rule requiring you to have no access to other borrowing facilities such as line of credit. So a lot of our clients or companies that we work with when this pandemic first hit, they were doing very well, and they had available lines of credits. But soon the business turned on them. I mean, we've seen some horror stories where some companies had a 95% reduction in 1 month in sales. And even though they had a line of credit, and maybe it was fully available before they had a 95% reduction in sales, it soon was no longer available, simply because a lot of times there's a collateral base that requires a minimum amount of receivables and good inventory. And so as the sales start dropping off, of course, your receivables start dropping off. And so you could no longer access that line of credit. Also, a lot of construction companies, their line of credit is there for make sure they get future work done. It's not there to fund losing or loss operations. And so they could, even though they had a line of credit, they could not simply access it because they need it for their bonding requirements to make it available. So we're recommending that every company that got a PPP loan document those uncertainties that they face when they complete their application. We believe that every company in every industry has been impacted somehow by this pandemic. I mean, the basic economy shut down for a good solid 2 months, maybe a month and a half. And whether you're feeling it today, down the road, you probably will eventually be impacted if you haven't been impacted yet. And so what we're recommending is that you document this uncertainty, and it's uncertainty, just keeping you up at night knowing that this downturn eventually will affect you. So again, forecasted loss operations that would show your cash depletion in the future. A reduction or slow down collection of account receivables. A lot of companies slow down payment of their receivables to their customers. I know we're seeing a lot of reduction in sales activities or bid opportunities, especially in the construction industry. While they got plenty of work today, there is a lot less work to bid on in the future. And when you start looking at the heavy highway construction companies and those that are primarily working on government projects, a lot of the governments are going to be short of cash. And so they're postponing doing future projects. Also, ODOT gets a majority of their money for heavy highway contracts from a gas tax. That gas tax was not collected very much over those 2 months because people simply were staying home and not driving. And so again, there's going to be they've already come out and said they're going to delay projects or push them out to the future. Supply chain and subcontractor disruptions. We see a ton of this everywhere. In the auto industry, maybe one of their suppliers was down, so they were no longer supplying the material necessary to complete whatever they were building or making. Subcontractors, we see a lot of this where a general contractor has maybe 5 different subcontractors: electrical, heating and air conditioning, drywaller. And a couple things can happen. First of all, one of them simply is shut down for some other reason. Maybe they had to break out of the pandemic within their own facility. And so what happens is, the electrical contractor can't come out, then that pushes back the drywall contractor. So again, a lot of disruption. Also, again, this contractors, I keep on hearing about this where, someone goes to the job site, they do all this testing now, which is good, it's required, and someone tests positive for COVID-19. Basically, they got to shut down the project, go in, do some remediation before they get the project back up running. Obsolescence of perishable inventory losses. The longer the inventory sits on your shelf, the more likely it becomes obsolete. Again, a slowdown in sales produces an oversupply of inventory. And the last one is work stoppage or cancellation by customers or local governments. We've seen this across the board in all industries, where the customer says, no, unfortunately, you can't come out to our building, we're locked down, or we're simply not ordering anything, or the local government has shut down a whole sector of the economy. So the forgiveness period. So under the Flexibility Act, that is now 24 weeks. So basically, you drew down 2.5 months or 10 weeks of payroll, and now you have 24 weeks, up to 24 weeks to spend that money on payroll or non-payroll cost. So again, all the guidance we're getting from the SBA and seeing from the SBA, they're intending everyone to reach full forgiveness. Again, the loan origination is the day the company receives its PPP loan proceeds. So that's the day you start counting your 8 or 24-week period. If you got your loan before June 5th, you can still use the original 8-week cover period. And there is a new updated application that came out June 16, 2020 to reflect all these new provisions of this Flexibility Act. So again, you get to use up to 24 weeks to incur the costs that you're going to put in your application for forgiveness. You can go as low as 8 weeks if you got your loan before June 5th. Prepayment expenses beyond your forgiveness period is generally not permitted. There is some guidance issued May 22nd, 2020 that we'll talk about shortly and how you measure some of these costs. Early on, we were getting a lot of questions about bonus or hazard pay. It came out in that May 22nd guidance that is totally permitted. Later on, in some guidance from the SBA, they did put a cap on owners' compensation. And so if you're using an 8-week period, it is the maximum of 15.38% of your 2019 compensation, not to exceed $15,385. And if you're using a 24-week period, the maximum you can claim for owner's compensation is $20,833. And how they came up with that is at 2.5 months of the maximum $100,000 worth of wages that you use in your drawdown of your loan. So definition of payroll costs, the same definition used in your application. It's all payroll of employees up to $100,000 per employee. Under the PP Flexibility Act, they said that up to at least 60% of the cover loan should be for payroll costs. Early on, there is some discussion of a cliff. The SBA director states that there is no cliff. So the thought was that, let's say, for example, you got $1 million loan and you only spent 50% or 500,000 on payroll costs in your forgiveness application. That is not the 60%. And so there was some thought early on that you would get no forgiveness. The SBA has ruled that that is not the case. You would get forgiveness for whatever expenses you list and qualify for forgiveness. Again, so salary, wages, commission are based upon each employee's amount paid up to 100,000 annually per employee. So that's prorated for whatever period you're using. Again, owner's comp, 8 weeks, 15,385, 24 weeks up to 20,833. So that every other employee, if you're using a 24-week period, you get up to 46,154 per employee forgivable payroll cost. And again, for 8 weeks, if you're using that shorter period, that is 15,385. You can include that on top of that, group health insurance, including union health and welfare benefits. Also, if you have a self-insurance healthcare plan, for whatever amount the company's paying that's not being covered by employee withholdings would qualify. Same thing with retirement benefit costs, including union retirement benefits. Again, any amounts of matches and profit sharing plan contributions that you are paying that's not being covered by employee withholding would qualify. State and local taxes on employees' comp. This would be your state employment workers' comp. And there is a new alternate payroll period that you can use for all these costs. So what is the alternate payroll cover period? This aligns with the borrower's payroll schedule. So the first payroll will be the first day of the company's first payroll period following the day they got their PPP loan deposited in their bank account. So the payroll costs are incurred during the 8-week alternate period, but paid after the end of the alternate carry period, you can still count that, just as long as they're paid prior to the next first regular payroll date thereafter. So the example in the guidance that was provided by SBA is that you receive your loan on April 20th. Your first payroll is April 26th after you got the loan. So you can choose either April 26th or April 24th for the start of your cover period, 8 weeks or 24 weeks. And so if you used the April 26th, you'd have until June 20th, one additional week to incur payroll costs under 8 weeks. And again, so you have to use that for the healthcare, the same period for the healthcare costs, retirement costs, and other payroll related costs. So here's an example of the payroll costs eligible for forgiveness. Again, 24 weeks up to 46,000 per employee, and 8 weeks, 15,385. And again, if you're using a period somewhere in between, which we'll explain shortly, you can use, you'd have to prorate it for those number of weeks, whatever's in your application. It's group health insurance, retirement benefits, and the state and local taxes. So in this example, there's 525. The non-payroll costs, this cannot exceed 40% of the total amount forgiven. So it's a less than 40% of the total amount forgiven. And there's 3 buckets that you can use: rent, utilities, and mortgage interest. And there's this logic called paid or incurred. So again, as long as it's paid and incurred before the end of your cover period, you'll be able to count all that cost. And I'll give an example shortly. So again, here's the example that was in the May 22nd guidance. Your cover period begins on June 1st and ends on July 26th. After June 1st, you pay the May and June bills before July 26th for utilities. So both of those bills count. Then on August 10th, you pay a bill that includes service up to July 26th. So you would include both of those, the May and June bills, plus all the costs on that August payment up to July 26th. So basically almost 3 months of utility costs you can include under this example. So what is rent? Rent is any payment under a lease agreement or rental agreement that was entered into prior to February 15th. It can include rent for real estate or personal property. So truck loans, copier loans. If you're a contractor and you're running a piece of equipment month to month on a job site, and that started before February 15th, that would qualify. So any type of rental or lease payments. Utilities, and all the standard utilities here: electricity, gas, water, telephone, internet access. The one I skipped over is transportation. That is the only guidance we have on that is some guidance provided to small borrowers of PPP loans. In that guidance, the SBA said this would be fuel to use in your trucks that the company is paying for. So we're taking transportation to be fuel cost. Any type of, if you have tow motors in your factory and they use LP gas, that would qualify. But any type of fuel necessary to use your equipment. Again, you have to document that these services were entered to the company by February 15, 2020. And the last one's interest. Again, this is interest on real estate or personal property loan, anything secured directly by real estate or personal property. The liability had to be in existence prior to February 15th, and you can't prepay interest cost. So here's an example of those three costs. And in this example is $275,000, which is under the 40% of $350,000. And so the last thing that you have to consider is FTEs. Okay, so you compare the FTEs either depending upon your period. In this example is 24 or 8 weeks. And you compare it to a prior period, which we're going to show shortly. And you also cannot reduce anyone's salary by more than 25% during your forgiveness period. Again, you're not going to get penalized if someone's hours were reduced. And so this example, they went from getting paid 40 hours to 20 hours. So that's a 50% reduction in their wages. But they were continuing to get paid at the same rate. You would not get hit with a wage reduction in this example, only with an FTE reduction. So there's 2 look-back periods for FTEs. You have to measure FTEs from February 15th to June 30th, 2019, or January 1st to February 29th, 2020. And so you take the lower of those two, and as long as your FTEs during your forgiveness period exceeds that, there is no deduction. The FTEs are based upon the 40 hours. Again, if you're using an alternate payroll cover period, you calculate your FTEs during that period. Anyone working more than 40 hours only gets counted as 1 FTE. And for those employees working less than 40 hours, you can either calculate a prorated amount or count them as a half of an FTE. You get to choose, and we're recommending you do both calculations to see which works out in your favor. So here's an example of the FTE reductions, and this one, the chosen reference period, which was the June 19th period. They had 62 employees. Now they're down to 60. So that's a 3.23% reduction in FTEs. So they're going to get the maximum forgiveness of allowable costs at 96.77%, the inverse of that. And I'll show you in the application calculation shortly how you come up with that. There are safe harbors. So as long as you hire someone back by December 31st, and if you're using the 8-week period is June 30th, and you hire them back, they count as a full FTE. Also, if you made a written offer to rehire employees and they rejected the offer, or the employees quit or were fired with cause, that is not considered an FTE reduction. Again, those offers need to be at the same pay rate, and you have to notify the state unemployment office that they refuse to come back. There is a new one that was made available under the Flexibility Act, and that is that you could document the inability to return to the same level of business activity that you were operating prior to February 15th due to compliance with a government requirement, those issued by Department of Health and Human Services, CDC, and the Occupational Safety and Health Administration. So as long as a lot of restaurants are forced with this, that they're not allowed to reopen, and right now I just heard like Florida and Texas and stuff are starting to close back their restaurants. Again, you are not getting penalized if that happens to you. And the compensation reduction, quite honestly, I'm not seeing anyone encounter this. It's very rare that you can hire people back at 75% of what they were making. They'll make more under unemployment, but this is an example of how you calculate that. And again, any amount in excess of that 25% reduction, so in this example, it's a 33% reduction, is shown as a subtraction of the amount available for forgiveness. So here is the calculation. So in these examples, we start with a $700,000 loan proceed. And we have various costs there, the payroll costs, non-payroll costs that add up to 800,000. As you can see, this is greater than 700,000. And then because of an FTE reduction, we get a maximum of 96% of that, 96.77% of the 800,000. So the total available forgiveness is 771,000, even with the FTE reductions. And then the loan, 700,000. And then the maximum loan using the 60/40 or maximum forgiveness using the 60/40 is 875,000. So you get the smallest of the three. So in this case, you get full loan forgiveness at 700,000. So there are some requirements that if you early on got an EIDL loan, you have to subtract that off, and that's loans that were originated between January 31st and April 3rd. Under the Flexibility Act, there is no required payments on your PPP loan until you hear about your forgiveness. So any principal, interest, and fees. So if it's fully forgiven, this would all be paid off by the government, and there'd be no required payments. Again, additional guidance will be we continue to expect to receive from the SBA. And again, the SBA has final say on all loan forgiveness. Just real quick to talk about the IRS position on the taxability of PPP loan forgiveness. In the CARES Act, it was specifically mentioned that the PPP loan forgiveness amount would not be taxable income. And on April 30th, the IRS agreed that the PPP loan forgiveness amount would not be taxable income, but it went on to say that any expenses paid for with PPP loan dollars that were forgiven would not be tax deductible. So they pretty much eliminate the tax deductibility of the expenses. Now, that was not the intention of Congress. Congress is currently working with the IRS, hopefully, to get this reversed. We're hearing that if they are unsuccessful with that, they are then going to just change it in a future law and say that it will also be tax deductible. Congress intended you always to receive full forgiveness of the loan and then also get another approximately, let's say 30% in tax deductions or tax credits to deducting those full amount of the PPP loans. So they expect you to get that benefit. So the forgiveness application, it's changed now. A revised one came out on June 16th. Again, there's been some questions about what documentation you need for the expenses. There is a separate document that has the instructions for the forgiveness application. On pages 6 and 7 of those instructions, you will find out for each type of cost what type of documentation you will need to keep and present. The way this application works, you provide it to your bank and they have 60 days to review and issue a decision. Then the SBA has 90 days to remit that money to the bank and have final say on that. Documents supporting your forgivable amount must be retained for 6 years. So the forgiveness application has an expiration date of October 31st, 2020. I think for these later loans, that won't work. I think they're going to revise that. In the Flexibility Act, they said all forgiveness applications must be due within 10 months of the end of the cover period. And under a recent SBA ruling, you may now apply for forgiveness before the end of the cover period. So let's say you want to go, you don't have enough costs for 8 weeks and you want to use the 24-week period. However, you're going to have enough costs, let's say at week 12. another month later, you can use that 12-week period for your covered period. You do not have to wait the 24 weeks. Again, we're recommending that you have more costs on the application for forgiveness than the amount of loan. So you don't want to, and it'd be very helpful if all those costs are payroll costs or less gray items. And so that would make the application process easier within the bank. Again, banks right now, I don't think are willing to accept these applications yet. They're waiting for additional guidance from the SBA. So again, you know, I think they're going to start accepting applications probably about the middle of July. I'm hearing from most banks. Again, whenever you do anything and you use a different cover period, let's say you're going to 12-week cover period, your average FTEs now are calculated on that covered 12-week cover period. So all the rules that follow the 8 or 24-week cover period would now follow a 12-week if that is the period you're choosing to file. And so the other thing that came out in this new application on June 16th is an easy application. It's a second application. It's quite clean. It's 2 pages long. And to qualify, you either have to meet one of the following items below. You're self-employed, or there's 2 elections here. You do not reduce wages of employees by more than 25%, and you do not reduce your FTEs, or you do not reduce employees paid by more than 25%, and you experience reductions of business activity as a result of health directives. Again, this is that order from governmental entities that says that you cannot fully reopen. So instead of filling in all these FTEs that's required on the general application and proving that the wage reduction on the general application, you select one of these boxes and certify that you met this requirement. And so there's no need to fill in all the FTEs. The SBA believes a majority of PPP borrowers will qualify to use this easy application. And we're seeing that pretty much so far, that most of the companies we deal with did not have an FTE or a wage reduction, and so would qualify to use this form. The other thing that changed in the Flexibility Act that a lot of companies are looking at right now is the payroll tax delay. So you can delay the payment of your 6.2% company match FICA. Starting back to, it actually goes back to March 27th. For most companies, we're suggesting April 1st, simply because your that'd be on your second quarter 941, which has not been filed yet. So you can delay making any payments of that company match on any payroll starting March 27th through December 31st, and then have up to 2 years to repay it. 50% will be due on December 31st, 2021, and 50% on December 31st, 2022. Again, this is an interest-free loan on this FICA match. Okay, so the PPP FA now allows this for any PPP borrower. Prior to that, it was only available during your forgiveness period. Now it's available throughout up to December 31st. So a lot of companies we're talking to are looking at this as another interest-free loan to help provide liquidity to their company right now as these continue to deal with cash issues. Again, when you're talking, if you're using a payroll provider, a lot of them are suggesting just going forward and saying that right now that they cannot go backwards and start this as of April 1st. When we've looked at this, there is a draft 941 out there that's going to be, we hope, released for the second quarter soon. There's simply a box that you fill in the amount that you want to defer. So you can do the full amount from April 1st through June 30th. Again, so I just work with your payroll provider to see if you can get the full amount deferred. So what are economic injury disaster loans? These are now available for borrowers through the SBA. All 50 states have been deemed an economic injury disaster area. If you apply for this, you're going to get automatically a $10,000 grant. If you do get this grant, that comes off the amount that's going to be forgiven on your PPP loan. You can apply for both. Just got to be careful that how you're using the funds. I mean, the PPP loan are used for those areas that we spoke about earlier, and you should use those up first to get full forgiveness, and then follow the rules for how you're to expend your EIDL loan. Sometimes they cover the same expense, so you want to make sure you've used up the PPP loans before you start using these EIDL loans. So there's no chance that the SBA can come in and rule that that you use the EIDL loan, which is a loan program, instead of the PPP, which is a forgivable loan program. So how do you do this? It follows the standard SBA application rules. So you must qualify as a small business under the existing SBA rules. So it's no longer less than 500 employees. It's decided industry by industry. You apply online. It's a quite streamlined application. I've had quite a few companies I've spoken to file for it. It's turning around relatively quickly, and they get back to you. The loans are up to $2 million. Now, this is a loan. You have to repay this loan. But the repayment term is 30 years, and the interest is not to exceed 4%. I recently heard of a customer getting a loan for 3.75%. Again, you just apply online. It's a really quick application program, and there is the links to the online applications. So again, the various programs are available out there through the CARES Act and existing SBA programs. Again, there's the Economic Injury Disaster Loan or the Paycheck Protection Program. Again, the PPP programs up to $10 million. You either have 2 to 5 years to repay at 1%. You apply for this through your financial institutions. The Economic Injury Disaster Loans or EIDL loans are up to $2 million. Again, 30-year repayment. This is a really long time. And you apply directly with the SBA. If you decide not to use the Paycheck Protection Program, you could use the Employee Retention Credit. It's maximum $10,000 employees. It's simply a credit to offset future FICA tax. Very limited to how you can how you apply for that one. So if you can apply for the Paycheck Protection Program, that's always much better than the Employee Retention Program. And then the last program is recently coming out. We expect to hear more about this. It's what they call the Main Street Lending Program. This is, again, a loan program. When it was designed for businesses that had a good, solid year end, December 31st, 2019. But then, and when the pandemic hit, they were hit pretty hard. So their bank was having struggles with maybe loaning them new amounts after they were hit by the pandemic. So there's two different ones. There's a Main Street Loan Facility and the Main Street Priority Loan Facility. The new loan facility is up to 4 times your EBITDA. So you calculate what 4 times your EBITDA. This is your December 31st annual EBITDA, 19. 4 times that. Take off any existing debt. That's how much additional amount you can borrow. Under the priority loan, you get up to 6 times EBITDA minus your outstanding debt. A minimum loan is $250,000. The principal payments are not, there's no principal payments for the first 2 years. And then 3 and 4, it's a 15% principal payment with a 70% balloon that hopefully by year 5, the economy has truly turned around. You can either refinance this or pay it off. There is no interest payments required during the first year. The interest rates are 300 points over LIBOR, which is currently at 3.2%. These loans are secured or unsecured. The borrower then sells off 95% of the loan to the Fed, and so they're only exposed to 5%. The real problem with talking with banks right now with this program is that the program requires the bank to do their first normal underwriting before they can participate in the Main Street Loan Program. So that's a conflict. I mean, when they go to do underwriting, a lot of times these companies have already been hit pretty hard by the pandemic and can't meet the threshold for the underwriting, so then they're not eligible. And this program was specifically put in place to make that available. So the banks are waiting to hear back. That's why this program is still not available. The banks are pushing back with the Federal Reserve, saying, "Hey, we're not going to write any of these unless you change the rules." So hopefully there'll be some rules change coming through, and this program will be made available. And then a couple of state programs. As we all know, there's been a deferral for up to now 6 months of your workers' comp. There was another second round deferrals for your June, July, and August payments are not required, they're deferred. And then also the workers' comp handed out a $1.6 billion dividend, which covered or returned 100% of your 2018 premiums paid. And the last one is, let's say that you've gone through the PPP program and the business is not coming back around yet, and you don't qualify for an EIDL loan. There is this Shared Work Ohio, which is a voluntary layoff aversion program. And the way it works is it allows you to retain your employees, but only partially pay them. You can pay them up to 50% of what they were making. And then the other 50% would kick in under the unemployment office, so unemployment services. And that would not hurt your unemployment rate. And you just work through this with the unemployment office. So the unemployment office doesn't also get hit with a full unemployment claim too, and they only get up to 50% of it. So it's a win-win program. Okay, so I got 15 minutes left here by design for any questions. So Mike?
Yeah, Bob, that was a lot of great information there. We got a couple of very good questions in here. The first one was, you mentioned that PPP funding under $2 million would not be subject to economic uncertainty criteria. We are at exactly $2 million. Would we be subject to the economic uncertainty criteria test?
I believe so. I double check the rules exactly how it's written.
Because it's really 2 million and under, or
Yeah.
under 2 million.
Yeah, I'd have to look at the Q&A to get an exact answer on that. But yeah, let me get back to that person or that company on that question. I'll look it up and get an exact answer, but I believe so.
Perfect. And then the next question was, what constitutes an owner? Any amount of ownership greater than a certain percentage, such as 5%, or is there a minimum ownership requirement?
That's a good question too. I think it's 50%. I think it's controlling.
All righty. Another good question here is, we are housed in a condominium. Are paid assessments forgivable?
No, unless there's a portion of that for utilities. Oh, that assessment. Depends on how that assessment, what costs are being covered by that assessment, but more than likely not. But I know some assessments could cover utility costs.
The next one was, can you use the easy form if you have reduced staffing simply due to a drop in demand or supply chain issues that are COVID related, even though there is no direct government mandating limiting your operations?
No. It has to be government ordered.
The next one is, what qualifies as transportation costs?
Again, a very gray area. We're hoping that most companies, now they have the 24 weeks, they would not have to go to that area as part of their cost, that they should be able to get enough payroll and payroll related costs to cover the full amount of the loan. But if they feel like they have to, what's very clear is fuel costs paid by the company for their equipment, trucks and stuff like that. I do not believe it's reimbursement like to employees under a mileage rate or anything like that. I don't think that would qualify. So I think it's purely fuel cost.
The next question is there a limit to health insurance or 401k match for owners in the forgiveness calculation?
Yes, there is. There is. And so I'd have to, let me see if I can quickly get the answer to that. But there is. So if they're self-employed, they get none of that because that's part of their payroll. So if they're a member of an LLC or they're self-employed, they get none of that. They don't get to include any health insurance or retirement benefits for themselves. So I believe that's the only way they would be limited.
All right, the next one says, we are an S Corp. Is the president of the S Corp considered an owner since he is majority stockholder?
Yes.
It looks like the final question here says, your example showed payroll costs offsetting the FTE penalty. Is this correct?
That is correct. The way the application is set up, that is correct. So the application that's currently been made available, the SBA, allows you to put your total forgivable costs on there, which could exceed the amount of your loan. And then you reduce it for your FTE, so you can pretty much buy your way out of an FTE reduction potentially by expending more cost.
We got two more that popped in. One says, how does my company handle submitting the forgiveness application when our fiscal year end is before the 24-week period expiration?
The application has nothing to do with your fiscal year end. You would put on the 12, whatever cover period you're using, 8 weeks, 24 weeks, 12 weeks, whatever it is, from the date you got the loan through the end of that cover period. Simply because you have a fiscal year to end it in there, it should not impact that forgiveness application.
And it looks like the final one that's popped in so far is, if 2019 profit sharing payment is funded during the cover period, does it qualify for forgiveness, assuming an S Corp or a C Corp?
Yeah, it doesn't matter if you're an S Corp or C Corp. There is a strong possibility that it could be qualified under incurred or paid, because it was paid. As long as it was paid during your cover period, whatever cover period you're using, 8 weeks, 24 weeks, or up to 24 weeks. Again, that's one of those gray areas. If you can have an application that doesn't have that on there and has other payroll costs, the likelihood of your bank accepting it and going through the forgiveness process increases probably a lot. Again, the way this is going to work is that you come up with your arguments to what you believe is the forgivable amount. You take it to your bank and put it on a forgiveness application. And then they have to say, okay, we accept this and we'll submit it to SBA. The downside that, I believe different banks are going to give different answers. So one bank will say that's includable. Another bank might say it's not includable. Then the worst downside is let's say you did claim that. Let's say it's $100,000 of a $500,000 loan, and you claim that matching payment that was made during your covered period. And you got to exactly the amount of forgiveness of $500,000. The bank accepts it, pushes the SBA, and the SBA comes back and says no. And if you would just waited maybe a little bit longer, you would have had all payroll costs to meet your forgiveness. And so there's no likelihood of that being disallowed. So again, you're taking some risk by putting these gray areas on there to shorten your period, where I believe you extend your covered period up to 24 weeks, you should be able to get with clean costs, payroll, utilities, and stay away from some of these gray areas for full forgiveness.
All right, so another question that came in that says, how do we most appropriately document or prove use of funds? Certainly this is significant in terms of meeting requirements of grant forgiveness. We can document having incurred expenses, but have questions on how to prove we actually use the PPP loan amount in meeting those obligations.
I don't think there's a requirement to do that. As far as I can tell, there's no requirement that you use those dollars. Again, if you're a not-for-profit, you're clearly not allowed to double dip. So if a grant is funding that payroll cost, it cannot also qualify for forgiveness on your PPP application. But again, that's only if the grant was using that as a qualifying expense. Again, there is no requirement to show that you exactly use these PPP dollars, exact dollars for this. The documentation that's required that you must maintain to document that you spent the money correctly can be found on page 6 and 7 of the loan forgiveness application. instructions. And again, they list, copies of bank account statements, payroll reports, a whole list of things that you should be able to keep to document how you came up with your expenses that qualified.
So if you pay health insurance on June 1st for June, but your loan is effective June 3rd, is the June insurance coverage period eligible for PPP?
Did you pay it before June, before you got your loan? So what happened here? Give me the
Yeah,
dates again.
it was paid on June 1st. The
Mhm.
PPP loan period started June 3rd. So it was paid 2 days before the PPP loan funds were received.
Yeah. There's no clear example of that. Now, again, you'll be able to pick up the ones you do pay during your covered period. Just when you quickly look at that, it was not paid or incurred. It was incurred. So yeah, I think you should be able to count that, but that's one of those gray areas because it was paid before you got your funds. So you obviously had other funds that you used to pay that.
Would the alternate payroll period factor into that if they would go before?
Yes, yeah, that could. Yeah, so they use that instead of the date they drew their loan and selected a date after. But again, you still got the same issue of paid. I mean, it was obviously paid with other funds before you got your PPP loan. So again, it's gonna be hard to argue that you use PPP funds when you didn't have the money to pay for it. So, again, with this extended period though, and you can use whatever period you want. You're allowed to select a period between 8 weeks and 24 weeks. So my recommendation is you might lose that one, but just go a month longer and pick up another month. So, you might want to go 12 weeks and pick up one more healthcare payment.
All right, the next question talks about the safe harbor exception for both full-time employee reduction.
Mm-hmm.
Is that for both the full-time employee reduction and the 25% wage reduction, or just the full-time employee reduction?
I thought it was just the FTE requirements, because that's, again, what you're doing is it's for the FTE requirements. So I thought it's only for the FTE requirements.
And then can the payroll costs offset the 25% test as well? This is kind of the follow-up to the original question.
Yes, it can. Again, so you can buy yourself basically out of both of these reductions with additional costs beyond the amount of the loan.
The next question says, remind me, EIDL granted will reduce PPP forgiveness?
Correct, the grant will, 10,000. Mm-hmm. So again, now if you apply for forgiveness and get your forgiveness and then apply for EIDL grant, you probably wouldn't have to do that because you've already applied for forgiveness. But if you got an EIDL grant before you applied for your forgiveness, you got to include it on there.
Another question that came in says, why does the owner's wages allowed seem to be less than the wages for an employee? For the 24 weeks, it's $20,833 versus $46,153.
Unfortunately, that's the way the SBA has rolled in their guidance. They are limiting employers' wages to 2.5 months, the amount you originally drew down. So again, that's how they come up with that $20,833. It's just, that's what they're requiring. Again, now it came out in guidance recently. And at first, everyone was concerned that if you went beyond 8 weeks, it was still going to be limited to 15,000. Now they said you get to eliminate the amount you included in your original application for your owners, which was 2.5 months or 10 weeks. And that's how that 28,000 is calculated. It's 10 weeks of 100,000.
All right, I think that's all we have right now. If any additional ones come in after we shut down, we'll let people know.
Great, it's right at 11 o'clock. Well, thank you, everyone. If there's any additional questions, please don't hesitate to reach out.
And I'm just going to chime in real quick. This is Susan Ross Wells again from Gilmore Jason Mahler. Just wanted to thank you, Bob, for doing this as always. I think very beneficial for everyone on the call. And Mike Bruff, thank you for handling our Q&A. And just again, a special thanks to the Chamber for partnering with us, Doug Jenkins. And I should mention, full disclosure, I'm a member of the Chamber Advisory Board, so always thrilled to see the Chamber coming forward with valuable information for members and other businesses. So Doug, just wanted to say thanks again. And also we'll mention that we're going to post a recording of this on our website at gjmltd.com/COVID-19 resources. So Doug, did you have any final words?
No, I think you guys covered a wealth of information there. Certainly appreciate all the information, Bob and Mike for running the Q&A, and Susan for inviting us to take part in this. I think it's great information for all of our businesses here in Findlay and Hancock County.
Excellent. Well, with that, I guess we'll say thanks to everyone for attending. And if you have any questions, please feel free to reach out, and we'll be sure to follow up and help answer your questions about the Paycheck Protection Program or anything else. So once again, thanks for joining and have a great day.